Whether you're a homeowner or a bank customer, understanding how the Federal Reserve raises interest rates can have a big impact on your finances. First, changes in the Fed's key interest rate directly affect adjustable rate mortgages and home equity lines of credit. These mortgage rates usually rise within 2 billing cycles after the Fed raises rates. When the Fed raises its key interest rate, banks also pay higher interest on deposits. Fed's cautious approach to raising interest rates. The recent invasion of Ukraine has made it difficult for the Fed to decide whether to raise interest rates. The country is a major producer of gas, oil, and agricultural products, and an ongoing disruption in supply could exacerbate inflation issues in the short term. The Fed is willing to be flexible depending on the situation. Powell's comments on the job market. In a recent interview, Fed Chairman Powell stressed that he wants to avoid squashing the job market in the process of raising interest rates. He also tried to reassure Americans worried about unemployment by promising that a recession will be brief and shallow. He also stated that the recent rise in inflation has impacted lower-income families and that it must be controlled. Powell warns against raising rates too quickly. Jerome Powell, Fed Chair, issued a statement on Thursday warning against raising interest rates too fast. These comments were made amid growing concerns about inflation and the state of the labor market. These are two issues that have split policymakers. Although the Fed's initial statement highlighted the strength of the labor market, it added that it needed to move at a slower pace to bring it back in balance. The fact that inflation has been higher than economists anticipated adds to the uncertainty. Powell stated that high inflation would be detrimental to the economy, especially for households with lower incomes. Powell's statement on COVID-19. In a statement to Congress on Tuesday, Federal Reserve Chairman Jerome Powell warned that an uptick in cases of COVID-19, the Omicron variant coronavirus, could threaten the U.S. economy. Although the new COVID strain has not been identified yet, it is raising concerns about the economy's future and the direction of inflation. Effects of Fed rate hikes on borrowers. With interest rates rising, more borrowers will face higher monthly payments. This is especially true of consumers with low credit scores. Higher rates can be a benefit to some home buyers, but they can also be detrimental for many borrowers. Recent Fed rate increases have made borrowing more expensive for many consumers. Market psychology, the impact of Fed rate increases. Traders are sensitive about changes in interest rates, and Fed rate hikes could have a negative impact on their portfolios. Traders may sell stocks and move into defensive investments in anticipation of a hike. Bonds are the most vulnerable securities. As a result, bond prices fall when the Fed raises rates. This is because new bonds will have higher interest rates and existing bonds will see a decline in price to reflect the higher overall rates.